Every finance creator tells you to dollar cost average into VOO. Here's the half of the research they never quote. The full data shows DCA loses to lump sum investing 75% of the time. By an average of 15%, nobody leads with that number. It's right there in the same dataset. The study everyone quotes also shows when DCA wins, it only wins by 13%. The math is asymmetric and not in DCA's favor. My name's Amy. I found the data buried in a Northwestern Mutual research paper most advisors skip past. In this video, I will show you the complete data on DCA versus lump sum, when the strategy actually earns its reputation, and a simple upgrade that beats basic DCA 90% of the time. Stay to the end. There's one finding in this data that changes the whole picture for 401k investors. Dollar cost averaging has one of the cleanest origin stories in personal finance. 1934, Benjamin Graham, Buffett's mentor, publishes the concept in his first book. The mechanics are simple. Invest fixed amounts at fixed intervals, same dollar amount, same day, every month, regardless of what the market is doing. The math behind it is genuinely elegant. When prices drop, your fixed dollar buys more shares. When prices rise, it buys fewer. You automatically accumulate more of something when it's cheap and ease off when it's expensive, without any judgment calls, any predictions, any emotional decisions. It's rule-based, it's emotionless. And it's what Warren Buffett recommended for ordinary investors in his 2013 annual shareholder letter. 70 million Americans do this every payday through their 401k, most of them without ever calling it by that name. The money comes out of the paycheck, goes into the fund, and the market does whatever the market does. That's dollar cost averaging. And the logic behind it is so consistent, repeated across so much financial content for so long, that most people no longer think of it as a choice. It's just how you invest. But the question nobody seems to ask is, compared to what? And that's the half of the study nobody quotes. To understand why DCA has its reputation, you need to understand the market environment where it actually shines. Volatile, choppy, going nowhere markets. And the gold standard example is the US stock market from 2000 to 2010. The S&P 500 opened that decade at its dot-com peak, crashed 50%, partially recovered, then crashed again in 2008. By December 2009, the index had delivered a total return of negative 9.1% for the full decade, the only complete negative decade for US equities in modern history. Now, here's what happened to someone who dollar cost averaged $500 a month throughout those same 10 years. They invested $60,000 in total. Their ending balance was around $64,000. Not great, but consider the alternative. A lump sum dropped in at the peak in January 2000, lost value for the entire decade. In a market that goes sideways or down, DCA wins. You buy more shares during the crashes, fewer shares during the recoveries, and your average cost stays below the ending price. The mechanism is mathematically sound, and this example is real. This is the chart that built DCA's reputation. Here's every decade since 1950. The bars show the percentage of rolling 10-year windows where lump sum outperformed DCA. Notice the 2000s. That's the evidence behind most of the DCA content you'll find online. Now look at every other decade. Northwestern Mutual ran the full study. 71 years of US market data, 1950 to 2021. Every possible starting point. Two approaches. Invest $1 million on day one and hold, or dollar cost average $83,000 a month for 12 months and then hold. Full range of market conditions, every portfolio allocation. Lump sum won 75% of the time in a 100% equity portfolio, 80% of the time in a balanced 60-40. And when lump sum won, its average advantage was 15.23%. When DCA won, its average advantage was only 13.33%. The wins are smaller, the losses are more frequent. This is what I'm calling the DCA half-truth. Every piece of DCA content you've seen was built on real data. The volatility smoothing mechanism is genuine. The lost decade example is real. But the complete picture across 71 years of rolling returns tells a fundamentally different story. Here's the mechanism. The US stock market rises in roughly 74% of all rolling 10-year windows. In a rising market, every dollar that sits waiting for its monthly deployment date is a dollar not compounding. DCA was built for the 26% of the time when markets fall. In the other 74%, it works against you. DCA doesn't have a flaw, it has a design spec. It reduces your time underwater, about 17.6% of periods versus 22.4% with lump sum, and cuts the average loss magnitude by roughly a third. It's an extraordinarily effective fear manager. The problem isn't using DCA. The problem is using a risk minimizer while thinking you're using a return maximizer. Those are different tools. Once you know which one you're holding, the real question changes. 3 investor types, 3 different answers. Type 1, you have a lump sum, an inheritance, a bonus, a home sale. If your horizon is 10 plus years and you can handle watching your balance drop without selling, the data says invest it immediately. You'll come out ahead 3 times out of 4. The one time you don't, DCA would have softened the blow. But you'd still be down in a decade where the market also lost money. You can't fully escape the decade you're in. Type 2. You're a monthly income investor. Your money comes from a paycheck. The lump sum versus DCA debate is irrelevant to you. DCA is simply the mechanical reality of how you invest. But this is where the research gets interesting. Which version of DCA? In 2011, researchers at the University of Nebraska published a paper titled Building a Better Mousetrap. They tested a modified approach called Enhanced DCA. The rule fits on a post-it note. Invest your normal monthly amount, then adjust it by a fixed buffer based on what the market did last month. Market went up, invest $200 less. Market went down, invest $200 more. That's the entire rule. No market predictions, no discretionary calls. One mechanical adjustment. The research found Enhanced DCA outperforms basic DCA approximately 90% of the time, adding 30 to 70 basis points per year in dollar-weighted returns. Here's what that looks like in your numbers. If you're putting $1,000 a month into VOO, which is exactly what most 401k investors are doing on autopilot, the Enhanced DCA upgrade adds roughly $300 to $700 per year. Over 20 years of compounding at historical rates, that difference compounds to somewhere between $30,000 and $70,000 in additional terminal wealth. Type 3. You're a 401k investor. Most plans don't let you change contribution amounts mid-year easily, but you have one lever. If your plan allows catch-up or additional contributions, consider front-loading in months after a down market. The Enhanced DCA principle applies wherever you have any discretion over timing. One flag for taxable accounts. More frequent adjustment means more tax lots, more record keeping, potentially more short-term gains. Talk to your CPA before switching to Enhanced DCA outside a retirement account. The 30-70 BPS annual improvement can be partially erased by tax drag in high income brackets. Here's the one-sentence version. DCA is the right tool for managing risk. Most people are just using it as a return strategy without knowing the difference. Subscribe for the rest of the data most financial content leaves out.